Now we will learn about sale-leaseback transactions. Sale-leaseback occurs when one party, the seller, sells an asset to the buyer, and then again the asset is leased back by the seller. For example, A has an asset and A sold it to B, and again A leased that asset from B. In this scenario now, A is becoming the leasee and B is becoming the lessor. So now it's really critical to identify whether A is eligible to record the sale of that asset, because ultimately A is getting back the asset and A is using it. So first, if A needs to record the sale of that asset to B, definitely that should meet the revenue recognition criteria, which means there should be a selling contract and the control of the asset should be transferred to B. And then again, A is leasing this asset and using it. So here, there might be a repurchase options or these lease options, but for that repurchase option, there are two criteria that both criteria should be met. And one criteria is that the selling price of the asset should be the fair value of the asset at that time when the asset will be repurchased, and then also there should be some alternative assets that are very much equivalent to that asset and those are available in the market. And then again, you have to check the residual value, whether the asset has any residual value. If there is like high guaranteed residual value, it's very unlikely that the control is really has been made or the asset is being transferred to the other party. So if these both criteria are met, then we have to check whether the transfer may be considered as a sale or not. So now we will see some examples and how we will record those. First of all, when the sales criteria are met. Second of all, when sales criteria are not met. See the example how we will record the journal entry when sales criteria are met and when sales criteria are not met. Now remember, one of the major criteria to record this type of asset sales is that the selling price should be equal to the fair value of that asset that time. Now, if there is any difference exists between the sales price of the asset and the fair value of the asset, then the sales price need to adjust it equal to the fair value. And in that case, if the seller needs to increase the sales price, that amount will be treated as a prepaid rent. If the seller needs to decrease the sales price, then that would be considered as a financing option. And if sales criteria are met, then the seller can record that sale of asset as a sales and record the gain on sales. On the other hand, if criteria are not met, then it will be just treated as a financing liability. So now here, billing company has an equipment and it's originally purchased 500,000. It has life 10 years. Carrying value is 415 after using it for 2 years, and then January 1st year 3 billing sold the equipment to Crane for 490,000, and that time the fair value of that equipment at that after using 2 years is 470. Now, Crane agreed to lease back the equipment to billing for 5 years with these lease cost, annual lease payment, and you also know the interest rate. Now, here we assume that those sales criteria are met. We can record it as a sales, but the question is, if the sales price and the fair value at that time is not equal, we need to do the adjustments. And you see here, the sales price is 490 and the fair value that time of that asset is 470. So this difference, we'll see that $20,000. What we are doing, we are reducing the sales price. So this $20,000, this difference, this $20,000, we will show it as financing liability, so we will exclude that from the gain portion. Now, if you sell any asset, how do we do the journal entry? So first, remember the asset, it's already on their book, so the asset or the equipment, in that case the equipment, this was purchased a couple of years back for 500,000, and then when they're selling it, the carrying value is 415. That means those the remainder amount were depreciated, so they have here accumulated depreciation portion, which is 85,000. So when we sell the asset, we'll record the sales, the cash received, we'll calculate the gain, and we'll also close these equipment and accumulated depreciation. So if it is qualified for sale, so we will record the sales and the gain they are making selling the asset. So it's sold for 490, so cash will be debit 490, and then we have to eliminate the equipment, which is a debit balance, so we will credit equipment 500,000. So we will credit equipment 500,000. We will also close the accumulated depreciation. It's accumulated depreciation is a contra asset or credit balance, so we will debit it. So we will debit accumulated depreciation 85,000, and apparently it may seem that the asset is sold for 490, and that time the carrying value is 415. So apparently it may seem that they are making a gain after selling the asset, which is $75,000, but remember they had to reduce the sales price to make it equal to the fair value of the asset at that point. So since they adjusted the sales price by reducing 20,000, so these 20,000 will be financing liability, and then the gain on selling that asset will be the remainder, which is $55,000. So we will record the journal entry like that way. So we will show this 20,000 as financing liability, and we will show gain after excluding that 20,000, which is $55,000. This is how the sale of that asset will be recorded. Now, how about the sales criteria are not met? If sales criteria are not met, it will be treated just like a financing liability, as if they are borrowing, as if they are getting a loan from the other party. So they cannot record the sales. They will still continue the asset on their financial statement. They will record depreciation, and since it's treated now as a liability, so they have to calculate the interest and they have to record the interest. Criteria are not met, again it's a financing liability, so they received 490,000, so they will debit cash and they will credit the entire amount as financing liability. It's not recorded as a sale of that asset or equipment, and they cannot show any gain related to that sale. So it is 490,000. Since it's like treated as a loan or financing liability, they also end of the year they have to record the interest. So interest rate is given 4.75. So if we count interest, we will record it interest expense debit, and we will adjust with the financing liability the amount here. So we will calculate it for 90,000. That was their total liability portion. 1 year just passed. If you take 4.75%, so we will see 1 year's interest expense will be $23,000. 15,275, so they will record it as an interest expense. And then since the asset is still on their book, they will keep recording the depreciation expense. So we assume that the assets carrying amount on that day it's given for 15,000, and then the remaining life 10 years. So if you take a straight line depreciation, they need to continue recording the depreciation expense, debit, depreciation expense, debit, and accumulated depreciation credit, and it's for 15,000, and straight line depreciation, if you divide by 10, your depreciation annually will be 41,500. So this is how they will keep recording depreciation. Asset is still on their book and they did not qualify, showing it as a sale.